Welcome back to Investing Talk podcast. Today, we're tackling a question that's likely on many of your minds, especially with the recent headlines. Is energy fuels a good time to buy now? We've got quite a bit of information to unpack here, giving you the full picture on this, uranium and rare earth player, and hopefully helping you cut through some of the noise. Before we jump into energy fuels, if you find these discussions valuable, please remember to subscribe, like, and maybe leave a comment. Your support truly helps us bring you these analyses. And hey, if there's a specific company you'd like us to look into next, just leave a comment below. We do read them.
It's definitely a complex picture with energy fuels, yeah. And as always, just a reminder, we're not offering investment advice here. Our goal is really just to break down the critical information from the sources we have so you can be well-informed and make your own decisions. Energy fuels is, well, it's certainly a stock that gets people talking, and for good reason.
Okay, let's unpack this company then. We should probably start with the fundamentals. What are the numbers telling us about energy fuels as a business right now?
Right, so looking at the latest data we have, Energy Fuels reported trailing 12 months revenue of about $65 million for 2024. But, and this is crucial, the net income is negative, significantly so, around minus $93 million. That gives you an earnings per share, the EPS, of about minus $0.48. So yeah, this negative EPS points directly to them being currently unprofitable, and they've consistently been in the red.
So, okay, revenue coming in, but losing quite a bit of money. What's the story there? Are these losses expected to continue, or is there, a light at the end of the tunnel, especially thinking about their production guidance?
That really is the core question, isn't it? Look, analyst consensus for the next quarter still anticipates negative EPS around minus 7 cents and revenue about $9.85 billion. Now, while that's still negative, it does suggest, a modest sequential improvement. What's really fascinating here, and maybe gives that glimpse of light you mentioned, is the reported sharp increase in uranium production. The guidance is up an impressive 22%, and the finished goods inventory soaring by 193%.
Wow, 193%.
Yeah, it's a big jump. So this rapid scaling, while it looks impressive for future revenue potential, it doesn't immediately solve the profitability puzzle. For a company like Energy Fuels, they're deeply invested in capital-intensive mining. The path to sustained positive net income, it's less a straight line, more like a winding mountain road. It's highly dependent on commodity prices staying stable or rising and operational efficiency at scale, which, as we know, can be brutally hard to achieve consistently.
That makes a lot of sense. It's a huge upfront investment for what they hope is a long-term payoff.
Okay, beyond just revenue and earnings, what about the company's broader financial health? What should we know about their balance sheet or market cap?
Well, the company currently has a market capitalization of roughly $2.37 billion, and there are over 230 million shares outstanding. They don't pay a dividend, which often suggests cash is being retained for reinvestment. But with these ongoing losses, cash burn is a key concern. While the financials do emphasize asset growth, the continued negative earnings and cash flow mean you really need to watch those future burn rates carefully. They're investing heavily in growth, definitely, but the question is how quickly can they actually turn those assets into consistent profits?
And when we look at their position in the wider industry, where does Energy Fuels stand competitively? Are they a major player or more of a smaller challenger?
They actually hold a pretty strong position as the leading U.S. uranium producer. That's a significant advantage, especially now with the focus on domestic supply chains. But their exposure, it goes beyond just uranium. They're also involved in vanadium, rare earth elements, and even heavy mineral sands. We're seeing clear sector tailwinds, from rising nuclear energy demand globally, and also these Western efforts to reduce China's dominance in rare earths.
Right, the rare earths angle is interesting.
Exactly. These factors really strengthen their strategic position. They could potentially benefit quite a bit from government incentives or, favorable policy shifts supporting domestic production in these critical materials.
So it's not just a straight uranium play, it's more of a critical minerals play overall. It gives them a bit more diversification, I suppose. But how much of that is like concrete revenue right now versus just a promising future story? Are we talking diversified income streams now or more diversified potential income streams down the road?
That's an excellent distinction, yeah. Right now, uranium is still the primary driver for sure. Their rare earth elements and the vanadium ventures are more about that strategic positioning and future potential. They've made strides, definitely. For instance, developing the U.S.'s only operating rare earth processing facility at White Mesa. That's a huge strategic asset. But the revenue from these other segments is still relatively small compared to their let's say, uranium aspirations. It's a long game, really, betting on future demand and those big supply chain shifts in these crucial materials.
Okay, moving beyond the operations side then, let's talk valuation. How is Energy Fuels actually priced in the market? What does that tell us about how investors are viewing the company?
Well, given its current losses, the
Hmm.
traditional metrics like price to earnings, PE, or forward PE, they aren't really meaningful. You can't calculate them if there are no earnings. However, the price-sales ratio, the PS, stands at approximately 36.4.
36.4. Wow.
Yeah. To put that in perspective, the average for basic materials companies is often, low single digits, sometimes even below one. So this dramatically high PS suggests a very premium growth story valuation. Investors are clearly betting on significant future potential, not current profits, and things like discounted cash flow models. They're also pretty unreliable because of those negative cash flows.
A PS of 36.4 is certainly eye-popping. So, if investors are paying such a premium based on that future potential, what are the inherent risks there? What happens if that growth story doesn't quite pan out as hoped?
That's precisely the risk, yeah. A valuation this high means the stock is highly susceptible, uh, vulnerable, really, to significant declines if those growth expectations aren't met, or if there's any kind of perceived reversal in that growth story. It's essentially priced for, well, maybe not perfection, but for very strong sustained growth. Any hiccup in production, any dip in commodity prices, any delay in policy support, that could lead to a sharp reevaluation by the market. And that could punish the stock disproportionately simply because of that lofty starting valuation.
Speaking of market evaluations, what are the analysts predicting for the stock price itself? Is there a consensus?
Well, analyst price targets for 2025-2026 range quite widely, from a low of about $7.25 to a high of $12.37. The consensus generally lands somewhere around $9.31 to $10.40. So this suggests a potential upside, maybe 9 to 23% from previous levels. But that wide dispersion in forecast really tells you how much uncertainty there is, even among the professionals. It's not exactly a clear-cut consensus by any means.
Okay, and what about the technicals, the chart stuff? What has the stock's recent price action been telling us?
The stock's recent price range was about $8.16.48. Over the past 52 weeks, it's seen a pretty big range, from $3.20 way up to $10.74. At the time of this analysis, the price was sitting around $8.47. Now, it's trading above its 50-day and 200-day simple moving averages, which were at $7.54 and $5.74 respectively. Technically, that usually indicates a positive trend. However, the trading is highly volatile. The beta is 2.06.
2.06, so twice as volatile as the market.
Roughly, yeah. It means Energy Fuels is about twice as volatile as the overall market. A 1% market move could mean, roughly a 2% swing for them, up or down. So yeah, hold on to your hats. Key support levels look to be near $7.50, and resistance is up around $10.50.
So Energy Fuels sounds like a bit of a wild ride then. What does that kind of extreme volatility imply for someone looking at this stock, whether for, a short-term trade or maybe a longer-term hold?
It definitely implies a need for a very strong stomach and really disciplined risk management. The Relative Strength Index, the RSI, which helps gauge if a stock is overbought or oversold, was sitting at 58.67. It's pretty neutral technically, but it is creeping towards that overbought territory, maybe suggesting some of that recent positive momentum might be stretching a bit thin. Recent volatility was measured at 14.56%, and the Greed Fear Index was at 39. That puts it in the fear zone, but it's close to neutral. Interestingly, 70% of the last 30 trading days actually closed with gains, so momentum was positive over the last month. But that high beta and the general volatility just mean sharp swings are common for this stock. It's really not for the faint of heart or for anyone who can't tolerate potentially significant drawdowns.
Okay, now here's where it gets really interesting, especially considering what literally just happened this week. What was the general sentiment and what were the upcoming catalysts people were watching for Energy Fuels leading into this week's news?
Right, so before this week's news broke, the analyst consensus was remarkably bullish. Quite strong, actually. We had 7 analysts recommending strong buy or overweight and projecting that moderate upside of 9.23% we just discussed. Key short-term catalysts included their earnings report, which was due on August 6, 2025. Everyone was watching that very closely for any signs of improved profitability or changes in production guidance. Also, any announcements of government support, perhaps for domestic uranium or rare earth processing, or even just positive sector-wide news, were expected to potentially drive shares higher. And long-term, the drivers looked even broader. Things like potential multi-year sector cycles in uranium, significant regulatory changes, maybe macro shifts towards nuclear energy for carbon reduction efforts, things like M&A, mergers and acquisitions, or vertical integration in rare earths could also unlock new value. And of course, major policy changes affecting global energy security would be massive potential drivers. Social media sentiment was generally neutral to positive, although some fear lingered just due to the broader market and sector volatility.
So, a pretty optimistic setup overall, it sounds like, but then boom. This week, we saw Energy Fuels stock plunge quite dramatically. What on earth caused that, and what does it mean for the uranium sector as a whole?
That's the critical shift, yeah. Just this week, on August 19th, 2025, Energy Fuels stock plunged a steep 18%.
18%. Ouch.
Yeah, and it wasn't isolated. It was part of a broader sell-off right across uranium-focused companies. The primary driver, the thing that essentially changed the game this week, was a pretty significant announcement from Kazakhstan. And as you know, Kazakhstan is the world's largest uranium producer.
Increased production, was it? How substantial is this increase, and why is Kazakhstan so influential? They really move the needle in the global uranium market.
They absolutely do. So Kazakhstan's national atomic company, Kazatomprom, through its KTK or joint venture, announced plans to ramp up uranium production at its Moincum deposit. They're aiming for 4,000 tons annually, starting in 2026.
4,000 tons.
Yes, and this is a big deal because it marks a return to their 2021 production levels. They had deliberately reduced output before because global prices were falling. On top of that, a new processing complex they launched just back in July 2025 will contribute significantly to this increased output. And Kazatomprom itself, the parent company, has also shown much improved financial performance recently, with revenue and profits nearly doubling in 2024. So it suggests they have the capability to actually execute these plans. Their decisions directly impact global supply, no question.
So what does this all mean for Energy Fuels then, and the overall investment thesis? Does this news effectively overshadow all that positive analyst sentiment and those short-term catalysts we just talked about?
Well, if you connect this to the bigger picture, yeah, increased supply from a major global producer like Kazakhstan can almost immediately put downward pressure on uranium prices. And that directly impacts the revenue and profitability outlook for companies like Energy Fuels, who are primarily producers selling into that market. So yes, this news likely overshadows a good portion of that earlier positive sentiment and those catalysts, because the market is now having to digest the implications of potentially lower uranium prices, maybe for the foreseeable future.
Yeah.
And it wasn't just the uranium news either. There was also kind of a ripple effect from broader market jitters. You heard some investors talking about bracing for a potential AI winter.
An AI winter.
Yeah, not literal snow, obviously, but a potential slowdown in the really hot tech and AI sector. When that happens, investors often pull back from riskier growth-oriented stocks across the board. And that can include energy and commodities as sentiment just shifts away from those high-growth narratives.
That's a pretty strong assessment. So are you suggesting those strong buy recommendations we just heard about are essentially, well, irrelevant now? Or is there still maybe a contrarian argument for long-term investors to consider, even with this increased supply and broader market caution?
The relevant might be a bit too strong for the very, very long term, perhaps. But certainly, the immediate term outlook has shifted dramatically. Look, the core bullish thesis for Energy Fuels relied heavily on rising uranium prices and strong domestic demand. Right? A major supply increase from the world's largest producer directly challenges that rising price assumption. It just does. Now, the strategic importance of domestic production in the U.S., that remains. But the immediate market dynamics become far more challenging. A long-term investor now would have to believe that either this supply increase from Kazakhstan is somehow temporary, or that global demand will eventually outstrip even this new supply. And that's simply a much higher hurdle to clear now.
Okay. Given all this, especially the recent plunge and the Kazakhstan announcement, what are the key risks we need to really focus on for Energy Fuels right now? What should potential investors be most worried about today?
Well, on a stock-specific level, those persistent net losses and the high cash burn, they continue to pose solvency risks, especially if the company needs to raise more capital and the market isn't as receptive as it was. That rich valuation we talked about, that super high price-sales ratio, it leaves the stock extremely vulnerable to big declines if growth expectations aren't met, or if this growth story reverses because of things like the Kazakhstan news. And then there's just plain execution risk. Scaling production and processing efficiently is absolutely key, and any delays or cost overruns would be heavily detrimental. Then from a broader market and sector perspective, uranium and rare earth markets are just inherently cyclical. They're highly sensitive to policy shifts, And as we've just seen very clearly, global supply dynamics. Price volatility is a constant risk, and competition from international producers, Canada, Kazakhstan, China, it's intense. Plus, any regulatory delays or maybe waning political support for nuclear energy or critical mineral initiatives, that could quickly undermine the demand side of the equation.
That's quite a list of risks to weigh. Of all those, which one do you think is the most impactful right now, particularly after this week's news?
Oh, without a doubt, the direct impact of increased supply on uranium prices. That's the most immediate and impactful risk right now. It directly hits their potential revenue, right?
Yeah.
And when you combine that immediate threat with their persistent losses and that already high valuation, it's kind of a double whammy. The other risks, they're always present, sure, but this supply shock from Kazakhstan is really the primary reason for the market's recent sharp reevaluation.
So putting it all together then, with all this information, including these very recent developments, what's the overall investment thesis for energy fuels? Is it, bottom line, a good time to buy now?
Look, the overall rating from our sources, even before this latest Kazakhstan news, was only a 6 out of 10, so kind of middling. Energy fuels certainly still presents, attractive sector positioning and some speculative upside, particularly if uranium and rare earth markets gain significant sustained momentum, or if strong government backing for domestic production really materializes in a big way. However, the persistent losses, that premium valuation, the high volatility, and the unresolved profitability issues, they significantly increase the risk profile. And while analyst sentiment was strongly bullish before this recent news, remember, even their price targets suggested somewhat limited near-term upside. Now, with the increased supply from Kazakhstan casting a pretty big shadow, that speculative upside is clearly more challenged, certainly in the near term.
And how should a potential investor think about the investment horizon for this stock, especially now? Is this more of a short-term gamble, maybe, or is it still a long-term play, but only for someone with a very particular outlook?
For short-term trading? Maybe. It might still be suitable for tactical traders who are looking for exposure around specific catalysts, maybe trying to play bounces, but only with very strict risk controls, especially given the dramatic news from Kazakhstan this week. For long-term investment, it remains highly speculative. It really does. It seems only appropriate for investors with a very high risk tolerance and a strong, almost unwavering belief in the long-term sector tailwinds for uranium and rare earths, despite these current supply headwinds. Steep swings, the possibility of dilution if they need to raise cash, those remain key caution flags. And perhaps even more so now, with the increased supply from Kazakhstan fundamentally altering the immediate supply-demand picture.
A truly fascinating and definitely evolving picture for energy fuels. It's such a powerful reminder, isn't it, that even stocks with strong domestic potential can be significantly impacted by global supply dynamics and, frankly, geopolitical moves.
Absolutely. And this really raises an important question, I think, for you, the listener, to consider. How much influence do these geopolitical moves and the supply decisions of major international players truly have on domestic market opportunities, even when we're talking about vital strategic resources like uranium and rare earths? And maybe more importantly, how quickly can those external factors change the entire investment landscape for a company? It's definitely something to mull over as you consider your own investing approach.
Thank you for joining us for this look into energy fuels. Remember to subscribe, like, comment, and maybe consider buying us a coffee if you appreciate our work. Your support really does keep us going. And don't forget, if there's a company you'd like us to dissect next, drop it in the comments below. We'll take a look. Until next time, stay curious and stay informed.